All right, guys, welcome. With me, I have another wonderful personality who would be joining us here today to explain to us Forex psychology. So, we want to understand that if you are not psychologically okay in the Forex trading market, you are going to be psychologically derailed, so to say. So you want to make sure that your psychology is in place. Once you have the right psychology, you are going to definitely do very well in the Forex market. And it's very important that you understand the things that you need to do to keep your psychology in place. And these are the things we want to, talk about today on this very live broadcast. All right. And before we start, if you have not already done so, please, if you have not already done so, click the subscription button right now. Click the subscription button, turn on the notification bell because we would be going live on different aspects of the Forex market and how you can grow yourself, how you can become a better person, how you become a profitable trader. We are going to be doing this over and over again. So you make sure you subscribe, hit the subscription bell button, hit the notification bell, and give us comments. Let's get your comments. What are some of the videos that you would want us to be doing, going live, or recorded videos that you want us to be putting out? What are some of your problems? We would listen to you and get this out. All our aim is to make you to become a profitable trader. With that being said, we are going right into the business of the day. In our last podcast, the Forex psychology part one, we talked about something very important, and that is our emotions. We talked about our emotions in our last part. We said that one of the things that get us so distracted and make us to lose money in the Forex market is when you begin to attach emotions to trading. When you attach emotions a lot to trading, then there is a problem. We also stated that if you want to really invest in any field, you have to, number one, understand what you're doing. Number two, make sure that you protect your money. All right? Understand what you want to do, protect your money or your capital, and then after that, what do you need to do next? Multiply your money. After multiplying, you begin to protect it again. You multiply, you protect it again. And that is why the psychology of trading is very important. So we spell it out in our last broadcast that you need to detach emotion from trading. Let emotion go one side. Don't bring it into trading. It's very, very important. Because it is said that once emotion comes in through the door, reasoning flies out of the window. And what does this mean? It means that as a trader, you would not be able to make important decisions, right decisions that will afford or help you to be profitable in the market if you attach emotions to trading. And that is why we stated that for you to be able to remove emotion, you have to understand that this is a business. And in a business, we have profit and we have losses. So once you're able to understand this, then your emotions will be down. And then you will do the right thing and you see yourself always be consistent. Please note, in the Forex market, you don't make money by praying. You don't make money by praying, all right? You make money by doing the right thing over and over again. We say do it until it becomes boring. Once you keep doing it, when it becomes boring, you're still doing it over and over again. That is when you've started it, all right? So today we want to go over the next thing, and then we will have the CEO of Dubis Integrated that has the Dubis Forex Academy come up and give us one of the very, very, very most important things that can help you to stay in the market for a very long time, and that is risk management. He's going to give a talk on that. All right. So without much further ado, let's continue. So today, the second one, apart from emotions that we discussed last time, we want to talk about okay. Sorry, the network, took us away, and we have to come back. We have to come back just a minute. Just a minute, please. All right. Thank you very much for being there. So, we are going to continue. We're talking about discipline. Discipline. Discipline is very, very important in trading. There is nothing you do when it comes to trading the Forex market. If you are not disciplined, then you will not be able to get what you want. Because at a point, it's going to become so boring that it seems as if everything is bad. But discipline will help to stay on the line, for you to be able to trade the forex market very well. We've talked about our emotions. You have to control your emotions. Number one, you have to be able to discipline yourself. All right? Now, the next thing we want to talk about now is expectation. 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 What do you expect out of the market? You know, in the forex market, there is no love and there is no hate. You have to just flow with the trend. You cannot say, oh, I love buying or I love selling. You see that the trend is going in a buy direction and you are selling always. Then you're putting yourself up for death. If you place a trade, it is out of place for you to begin to expect that the trade must always go in your favor. Remember that we said this is a business. Sometimes businesses don't go the way you want it to go. And if businesses don't go the way you want it to go, you should be able to get yourself prepared for when it is bad and when it is good. So your ability to get yourself prepared for when it is bad and when it is good makes you a good business person. And that's the same thing you want to apply to the forex market. There would be times that you will not be able to make profit. There will be times that you make a lot of profit. But when you place a trade, it will be very, very wrong for you to start thinking that the trade will always go in your favor. And that is why it's important that you try as much as you can to always use your what? Always make sure that you use your stop loss. Once you do that, it is going to help you to understand or always be in the right track, because already you have prepared yourself for any possible outcome that may happen. All right. So it's very important that we do this. And once that is done, we are going to be profitable traders. All right. So thank you very much. The next thing we would be talking about in this broadcast, or when it comes to forex psychology, is a very important thing that a lot of people overlook, and that is breaks, taking breaks. You know, sometimes when you are winning the trades and you have these periods where you are always making profit, let's say about 5 times you trade for about 7 times, 10 times, 20 times, and you're always making profit. You know, you want to keep going. You want to keep going. No, take a break. Take a break. At that point, make sure you do what? Take a break. You know why? The reason is, if you do not take a break, if you don't take a break as at that time, then you're going to have a problem. You're going to have a problem. And what's that problem? You will feel invincible. And once you feel invincible, you are going to make wrong decisions. You definitely make wrong decisions. And when you make wrong decisions, you're going to lose your trade. All right? So it is important that you try as much as possible to take breaks. What's the next thing you want to do? When the trade is not going, once the trade is not also going in your favor, once the trade is not also going in your favor, please always ensure that you take breaks. Ensure that you take breaks. Now, when you ensure that you take breaks when the trade is not going in your favor, that time will afford you the opportunity to take a critical analysis to make sure that you. So it is very important for us to take breaks. Don't just trade like that. Rather, take breaks intermittently and analyze yourself. If you have won a lot of trades, please stop there. Trades. Also, we'll be talking about staying. What do we mean by staying on the fence? What does it mean to stay on the fence? Staying on the fence means not doing anything in trading. You are not placing any trade, you're just watching what's happening in the market. Lots of people, you have this urge to always place trade. I want to place trade, I want to place trade. No. At times, it is important that you stay on the fence. Do not place any trade at all. Yes, we have been able to look at these few things that will really help your psychologist to be this. And once that is done, you will always make profit in the market. And we have talked about 5 most important things. Number 1, manage your emotions very well. Manage your emotions. I do not want to overstress that. Manage your emotions, right? Don't attach love, don't attach hate to your trading. It's a business, all right? Then your expectations. Do not be expecting win at all times, because once you expect win at all times, you are going to definitely fail, or you are going to experience this downheartedness when the trade is not going in your favor. Then the next one is you need to be very disciplined. You need to be disciplined to the end, and then take breaks. Take breaks. Once the trade is not going in your favor, take breaks. Then, of course, there are times you don't have to do anything. Just stay on the fence and watch the market. Thank you so much for the very part. The next part we want to look at is another very important part, and that will be risk management. So the CEO of Dubis Forex Academy is going to talk a little. I know I'm not going to
Yeah. All right, Mr. Manuel, can you hear me? Okay, Mr. Manuel, can you hear me? I don't know why the network is very bad, very poor. The network providers. Can you hear me? Yeah, can you hear me? The network is so bad this morning. I don't know if you can hear me. Are you there? Can you hear me? It's like the network, I'm not being connected yet. Oh. Now, what is happening with network? MTN, and it's not going now. And it's connected. It's connected. Because when you were talking, it was breaking and breaking.
Were you hearing?
Some, it was breaking, seriously. I don't know. I don't know if people are hearing us. Okay. All right. I don't know if people are hearing us. How do I know if people are hearing us? Okay. Oh, I don't know if people are hearing us. Okay. If you're hearing me talking about the psychology of the market, proper risk management is the most important thing when it comes to trading. When it comes to trading and being consistent in trading the financial markets and making profits, you need to take notes. You need to take it very serious about proper risk management. You need to take that into consideration. Proper risk management. We said that our risk is a potential of bad outcome, the potential of underperforming. There are periods that market will not go your direction. And the only thing that can save you is how you manage your risk. Proper risk management. What is risk management? Talking about risk management is just all about the use of stop loss and as well placing your stop loss at the right place to risk a certain amount of your account. We tell people to risk nothing more than 2% of your equity, risking between 1 to 2% of your equity. For example, me, I risk, in fact, 0.5 to 1% of my equity at a time per trade. That's what we mean by proper risk management using stop loss. Very important to protect your capital. Stop loss is very important to protect your capital. You need to plan in advance your stop loss level. You need to place stop loss while placing a trade. In fact, you don't need to remove your stop loss due to fear that the trade is about to go against you. In fact, stop loss should be a blessing in disguise. When it's not every time that you're right in your analysis. You may be right in your analysis, the market can decide to go the other way around. The ability for you to be able to manage your emotion when you place a trade is very important. That is to say, the ability for you not to remove your stop loss due to the fear due to the fear of losing that particular trade. It's better you lose your trade, a particular trade, in order to protect your capital. Some persons can decide to expose only one trade and lose their equity, their entire capital, your trading capital. That is very wrong. Stop loss is very important. Proper risk management and money management, very, very important. Some questions we usually get: how do I open position and how many should I open to reflect proper risk management? How do I break one trade into multiple trades to in trading? There are a lot of people that open multiple trades, and at the end of the day, it does not reflect proper risk management, risking a certain amount of your account. In fact, before you enter a trade, you need to first of all be able to say, are you willing to, the loss? Are you willing to accept the loss? Any loss you cannot accept, don't go in for that trade. Don't only think about the profit you want to make. First of all, you need to think about the loss first before you think about the profit. Thinking about the loss first before thinking about profit. Very, very important. Note that. Now, you also need to think about the risk to reward ratio. What is the risk? What are you willing to risk? And what is the reward that you want to get? You cannot be risking, for example, risking 20% and your reward is 1%. No. Your risk to reward ratio. What is the amount of what you're risking vis-a-vis what you are expecting, as in the profit, the reward? Now, You also need to know that it is not every trade that is meant for everybody. There are trades that is not meant for you, because you need to think of, for example, how much do I have in my account? You cannot have $100 in your account and you're thinking about trading S&P 500. You cannot have $200 in your account and you want to maybe take a trade, that's a swing trade that can take up to 300 pips as stop loss, or even 500 pips as stop loss, whereas your equity is just $200. So not every trade is made for everybody. Now you need to also, before you start trading, think about the correlated pairs. What are the correlated pairs? Pairs that are correlated. Very, very important that you understand that. Correlated pairs. Correlated pairs, very important. Now, we had so much network issues, and we've already spent a lot of time. So we are just going to, let me give out the formula first. The formula for you to use and trade to end up risking what you plan to risk, as in percentage. You need to first of all determine what do you have as equity first. So the value of your risk in percentage, you need to determine the value of your risk in percentage. You need to first of all agree with yourself, how much percent of my account do I want to risk per time? This is what you need to first of all write down. How much percentage of my account do I want to risk? For example, you decide that you want to be risking 1% per time. Then you need to know the value of that 1% of your equity. That is to say, the formula is the value of your risk in percentage over the total number of stop loss in pips, and this divided by standard loss size of 10. That will give you the correct loss size that we use and trade, and you end up risking what you plan to risk. For example, either 1%, 2% of your equity. Remember, I said that you are supposed to just risk 1 to 2% of your account per time, per trade. 1 to 2% of your account per trade. This is the only thing that can keep you to be consistent in the market and be profitable. If you don't take into consideration proper risk management, if you don't plan your trade in advance, plan the risk, what you want to risk in advance before entering a trade, then you may end up gambling in the markets. You may end up exposing all your accounts. You can agree with me, offline business, you cannot actually come to do a business and you expose everything you have in your shop just to transact one business. If everything you have in your shop is at risk just to take one business, then that business is not worth it. So same thing, if you're trading in the financial market, if you're trading, whether you're trading currency market, whether you're trading stock market, whether you're trading energy market, commodity, whatever thing you're trading, you need to first of all think about, before I place this trade, what do I stand to lose? Now, if you decide to plan to lose only 1% or 2%, and you place the trade and eventually it goes against you, you know that this is already what you plan to risk before going into that market. This market is the only market that before you enter into it, you already know what you stand to lose. That is if you do the right thing by using stop loss, by placing your stop loss at the right place. We call it calculated risk. So you need to take calculated risk. So I tell people, like I said before, 1 to 2%. So how do you know that if I place the trade, I will end up risking or losing 1% of my account? Like I said before, the formula is determine the value. For example, if the value of your equity, of the percentage you want to risk, let's say you have $1,000 and the 1% of $1,000, let's use 2%. 2% of $1,000 is $20. So once you get the value, which is $20, now you use that $20, which is the value of your risk in percentage. You divide it by the total number of stop loss in pips. The total number of stop loss in pips. That is to say, where you're placing your stop loss. Let's say your stop loss is 100 pips. So you divide 20 divided by 100. 20 divided by 100 will give you 0.2. Then the 0.2, you divide it by standard loss size of 10. When you divide it by standard loss size of 10, it will give you 0.02. That is to say, on a $1,000 account, you are supposed to just use 0.02 if your stop loss is 100 pips. So you're supposed to use 0.02 to take your stop loss. Then you divide it by 100. Like I said, sorry before I was interrupted. So the question is, how many of us is actually taking trade of $1,000 with 0.02 lot size? When someone have $1,000 in account, you can decide to use either 0.02 or 0.02. Okay, so I think if you have gotten what I said, let me come back again. Let me summarize. I said that you need to plan your stop loss in advance before placing a trade. Very important to protect your capital. You don't need to remove your stop loss due to fear. Don't just take a stop loss and put anywhere you like. You need to use proper risk management by placing your stop loss at the right place to give you a certain percentage of your account. How do I know that if I put this stop loss here and I use this loss size and I will end up risking 1 or 2% of my account? And I said the formula is just first of all, determine your risk in percentage. What is the value of your risk in percentage of your equity? And I use $1,000. If your account is $1,000, your risk, if you're risking 2%, $20 is the value of your risk in percentage. Then you divide it by the total number of stop loss in pips. Your stop loss in pips is how many? Is it 50 pips? Is it 30 pips? 100 pips? And I decided to use 100 pips. So $20 divided by 100 pips will give us 0.2. Now you need to divide this 0.2 by standard loss size of 10. When you divide it by standard loss size of 10, it will give you the right loss size that you have to use to take that trade, and you end up risking that very percentage you want to risk. So 0.2 divide by 10 will give you 0.02. So if you place a trade 0.02 and you put your stop loss at 100 pips, you will end up risking losing, if the trade goes against you, only 2% of your accounts. So this is what people find it difficult to do. A lot of traders, they will place a trade, they will put it open, no stop loss. If you're trading without stop loss, you're just gambling with your money. So if you want to be consistent and make profit in the market, you need to learn how to use stop loss, and you need to place your stop loss at the right place. We call it protective stop loss, because stop loss is actually protecting your equity and your account. You need to use the stop loss and you need to place it at the right place. Once you use your stop loss and you place it at the right place, you end up losing exactly what you plan to lose. Even if you lose consistently 10 trades at the same time, you will end up losing 2% of your equity at that particular time, each time you place the trade. And there is no way you can blow your account using stop loss, putting it at the right place. There is no way you can blow your account. So stop loss is actually a blessing in disguise. So when a trade hits your stop loss, don't cry too much. There are many 1,001 opportunities in the market. So the one that did not go, just let that one go, and don't expose all your accounts at the same time. Next time, I will talk about the risk to reward ratio, and I will talk about how to open multiple trades. At the end of the day, you end up reflecting proper risk management, how to break your trades into twin trading. There are a lot of people that do twin trading or triplet trading, how to do that, and you will still reflect proper risk management. In our next class, we will talk about that. And also, we'll talk about currency pairs that move together and the one that don't move together. That is to say, we'll talk about correlated pairs, because some persons, they will, put their risk on one particular, they say they are trading different pairs, but those different pairs they are trading is actually same, they are correlated. That is to say, if you are risking 2% and you're placing on 10 trades, and that 10 trades are correlated, if you lose, you just lose the 10 at the same time, you end up losing 20% at the same time, because they are correlated pairs. So we'll talk about that next time we'll have this training. But just note that you need to learn how to use stop loss to protect your equity, protect your capital. So stop loss is actually protecting our capital, not to make us to lose money, no, but to protect our capital. When the trade is not going our direction, it will protect our capital. So you don't need to be emotional about it. Just need to place your stop loss at the right place. Determine what you want to lose first before going into the market. Think about the losses first. If you do that, that is the skill we are talking about. But if you're not trading with stop loss, that's to say it's your gambling is not a skill. So the skill of trading the financial markets is all about using proper risk management.
Wow, wow. Thank you. Thank you.
So that's what will
Thank you.
guarantee your success trading in the
Thank
financial
you
market.
so much.
So
Thank
thank you
you
very
so
much.
much.
Thank
Thank
you
you
very
so
much
much.
for watching. Yeah. So Mr. Manuel, over to you.
All right. Thank you so much. We are so happy for this session. We have learned a lot. Yes, we've spent about 36 minutes, even though the network was trying to make us not to have what we're supposed to have. But here we are. We've defeated it and we've learned a lot today. So, guys, once again, thank you very much. We hope to, come your way in our next broadcast and teach you some of the things that you need to know. Our aim is for you to become profitable as a trader. So you want to keep learning, keep improving yourself. I want you guys to drop a comment in the comment section. If you have any question, drop it in the comment section. Like the video, share it to your friends, and the sky is going to be our starting point. If you have not subscribed to the WinForex TV, please make sure you do that. WinForex TV, make sure you do that and turn on the notification bell, like the video, so that once we release new video and schedule new broadcast, you would be the first to be notified. Thank you very much, guys. See you next time.